Welcome back, everyone. Thanks for joining me today as I go through this video on risk management and how it impacts your trading. Now, what is risk management? It's basically how you manage your money in your trading. The way you manage your money in your trading will determine how profitable you will be as a trader. Now, what are the things you think impact your trading the most? Is it your strategy, your indicator, your trading session, the asset you trade, the technical analysis you do, or fundamental analysis, trend, or is it your mama? Right? It's neither of these, to be frank. It really is your risk management. Now, there are three main components to risk management. You have the capital that you risk, how much you risk per trade, and how much you expose, your maximum exposure. As it relates to risk capital, this basically means that the amount of money that you're willing to lose while you trade. So if you know you have rent to pay, you have food to buy, you have kids to look after, and you have $10,000 in your bank account, would you put up the $10,000 to trade, to enter your trading? No, you would not. Obviously, you would need to leave something to take care of your life daily. So if you choose to put up $1,000 and say, all right, this is what I'm going to start trading with, this is what I'm okay with losing if I do lose everything, right? You have to be comfortable with the capital that you risk and be okay with the fact that you may lose everything, because remember that 95% of traders fail on a daily basis, right? So the money you're willing to lose is important. The risk you take per trade, as a newbie, I would say do not take more than 1% per trade on your account. For experienced traders, up to 2%. It may be more, but that's the recommended number I would use. In terms of maximum exposure, the risk per position or the number of trades you can be in at once. Now, this basically means that if on any given trading day, you want to ensure that you're not, so for example, if you set a maximum of 5% on your account and your account balance is $10,000, you would not be risking more than $500 at any one time while you're trading. So you would not, so for example, if you're risking 1% per trade, you know you would not have more than 5 trades open in any day. And that's how you would help to preserve your capital and to manage the money that is in your account, the broker's account. Right? So these three components are very important, very critical, and they help you with managing how you trade, how you risk your money, and basically getting to profitability. Now, things to avoid when trading. Always set a stop loss when you place a trade. It is very, very important. Putting in a trade without putting a stop loss is like you're saying to the broker or to the market, okay, I'm willing to lose every dollar right now that I have in my account. That makes no sense. It's important to know your trading parameters, meaning you know that, okay, you anticipate that this trade is going to go up, the market is going to move up, but you want to be sure that you cannot be 100% sure at any point in time. The market may always go in the other direction. So you want to make sure that if you're wrong, you know quickly. That's how I always think about it. You know quickly, you're taking out based on the amount you're willing to risk in terms of what you're willing to lose. And you work that out in terms of percentage and you set that as your stop loss. Ensure you have a stop loss at all times. Do not adjust your risk based on how you're feeling or how your emotions are. It's not a good practice. It will not help you to become a profitable trader. That's the bottom line. Your feelings and trading do not go well together. Do not practice revenge trading. Revenge trading is, you would have, for example, been trading all day today or over the week, I should say. You lost 5 trades over the week. and each trade you lost $1,000 working with the same $10,000 balance. Now, you're telling yourself on a Wednesday that you want to close off the week by making back the money that you have lost Monday to Wednesday. No. In going after and chasing that target, you're going to be making mistakes. There's no doubt about it. Revenge trading is not healthy for your account. It forces you to think irrationally, and you're not using a plan when you're doing revenge trading, right? The fear of missing out. Now you're sitting there, you're watching the charts, and you realize that, for example, Bitcoin starts to shoot up. And you're telling yourself that, Bitcoin is moving and I didn't get in on this trade. I need to get in as fast as I can. And you place an entry on Bitcoin for a long. Now, what you didn't anticipate was that there was an order block and on the higher time frame from what you entered on. And when price gets to that area or that point, it will reverse, it will bounce. You didn't anticipate that and you did not see it, and you entered right below there. You'd have lost your money again. So the fear of missing out does not help you at all. And remember, with the abundance mindset, there are always opportunities in the market. So if you miss this opportunity, there will be another 10 ahead of you to plan for and enter into the trades, right? Now, risking too little, this does not help you either, because obviously you've started trading because you want to make money. If you're going to do 1-to-1, for example, even 1-to-2 is better than 1-to-1. 1-to-3 better than 1-to-1. 1-to-1. The 1-to-1 scenario, it doesn't help you so much, right? And it's always good to know that if you're risking $1, you're at least getting more than $1 if you have won that trade, right? So it helps you to get there faster, but you at the same time you don't want to get there too fast by risking too much, because if you risk too much and then you're not winning the trades, then obviously your account will be blown, right? So bear in mind these things to avoid. Also, remember, what goes on in your mind is what manifests on your charts and in your bank account. I cannot stress this enough. The mindset work is so important. It is the number one thing. Secondly, it's the risk management on your account. Don't forget these two things. Now, the tips I have for you when it comes to risk management. You need to set parameters. For example, you don't want to be over trading. You need to decide how much you want to be trading on any day, on any trading day. Do you want to be taking 2 trades per day, maximum 5 trades per day? Let me give you an example. You'd have taken for the week 10 trades, and you're supposed to only be taking 5 trades for that week, but you took 10. And you won 5, you lost 5. You're ending up back in the same position where you started because they cancel out each other. It didn't make sense. So sometimes when you don't set these parameters on how often you trade, you tend to overtrade and you tend to basically lose. It doesn't make sense. It's important to control your emotions when you're trading. Control your fears, your greed. How can you control your greed? You can set in your trading plan, you want to have a target as it relates to your risk to reward ratio. So if you're aiming for a 3-to-1 on each trade, stick to that. Do not try to go over that. Even if you see that the trade is going to 100-to-1, stick to the 3-to-1, because compounded over time, that will add to your profitability and that will give you more consistency. In terms of fear, when you don't plan your trades, you're going to be more fearful of the outcome because you're not sure of what is happening because you didn't take the time to study the market, right? So it's important to go into your trades with a good mindset, plan your trades out, and make sure you know what you're doing. And it ties into what I have there in terms of planning your trades. Your mindset is always important. Set rules about how you trade, entry rules, exit rules. For example, you want to see certain confirmations before you enter a trade, whether you want to see a certain pattern or you want to see a certain candlestick or whatever the case might be. Have rules about how you enter your trades or how you exit your trades, and always follow your plan, because that is so critical, because once you start to deviate from the plan, then that means you're working with your emotions and your feelings and not working with the more objective things that you have placed in your plans. I use the term a magic number because, what's a number that you can safely say that if I risk this amount on my account, I won't blow my account? And the general rule is 2% is a good number for you to be able to risk per trade on any trade that you take, right? This helps to mitigate against big losses. It helps you to preserve your capital. It gives you chances to re-enter the market, and it helps to give you time to grow as you trade each day. So the magic number 2% is a good amount to risk on any trade on your account at any time. But just remember the parameters of your maximum exposure and your risk capital. Manage those in tandem with each other, and you'll be good as to how you manage your money in your account. I want to thank you very much for watching. I hope you learned something from this today. And of course, if you have any thoughts or comments, please leave them below. I'll be sure to answer you. Thanks. Have a great day and a great trading week.